Welcome back. You're still watching Markets at Noon, and let us now understand what should be the long-term picture for the market and what should be your style of building the portfolio at this point in time, at this juncture. And for the same, we have market expert Sunil Subramaniam joining with us. Sunil, good afternoon. Thank you so much for giving your time to ETNOW. Mansi Dave this side. My first question to you, of course, on the market, as global headlines rattle the sentiments, but the markets are resilient despite the tariff uncertainties. We see the DIs constantly supporting the market, and what a conviction we see from the market participants. The latest AMFI data explains SIP flows increased to all-time high of 28,464 crore. How are you reading all of these?
Well, you mentioned that strong support of DIIs, but I would actually say it's a strong support of retail investors in India. See, the DIs have no choice in the matter because mutual fund investors are filling their coffers with money. Despite all the tensions of the last few weeks and the months, retail investors are constantly reposing their faith in mutual funds. And with mutual fund managers, there's a limit to how much cash they can keep. So the point is that it's actually the faith of the common man in the Indian future of the economy, of the markets, of everything that's driving this. And DIIs are only pass-through vehicles. They may choose which sectors to put in, which cap curve to put in. Even that is limited because about 40% of the total flows that come to the mutual fund industry are in the mid and small cap broader market. So I think that ultimately we have to give credit to the Aam Janta or the Aam Aadmi, whichever you want to call it, that they are increasingly reposing their faith in the economy, in the current leadership of the country. And in fact, Mr. Trump's 50% tariff is probably acting as a rallying point for the country to take a very strong stance. So let's give a, hand to the Indian public that they are standing firm in the faces of the FII selling that's happening. So that I think will continue. And you will see that the domestic data are coming through very strong. You saw the cut in the inflation to 8-year low. And naturally, that strengthens the case for an RBI rate cut in the next policy. And the US Fed also now most likely to do a rate cut in September is what the data are showing, which means RBI's hand will be, I would say, strengthened even more for a rate cut because then the differential interest rates between India and US will widen and cause pressure on the rupee. So all in all, I would say that even a 50% tariff probably 0.5 to 0.8% is the worst case scenario on impact on our GDP. So we'll still be at 6% plus. So I would say there's good news at domestic front. Mr. Trump and the international scenario is not very comforting. So FIs are still selling more, but the markets will then move. And I'd like to use, if you don't mind, a Hindi Bollywood correlation here to the markets, right? So there used to be this villain called Ajit, very famous for his one-liners. So there's a famous one-liner of his which applies to the market at this point, and that's इसको लिक्विड ऑक्सीजन में डुबा दो, लिक्विड जीने नहीं देगा और ऑक्सीजन इसे मरने नहीं देगा. Which means what the market situation is, FIs इसे बढ़ने नहीं दे रहे हैं और DIs इसे गिरने नहीं दे रहे हैं. So the market is in a liquid oxygen state. Which I would say,
in this entire story, I like that the hero is the Aam Aadmi. Aam Aadmi, but khas performance. We would like to sum it up that way. But having said that, Sunil, markets really dislike uncertainty, and I really want you to elaborate and focus more on the timing of this uncertainty. We are looking at a festive season. It's almost started now. A time where it's very important for sectors and companies to take it out as much as they can from this particular festive season. The hopes are really high as well. Now, having said that, do you think the international triggers or the headwinds or the overhang that's there on the market would be actually driven or taking back a seat because of the festive season? How optimistic, how bullish, and how much are you counting on this festive season for India being strong on the domestic front right now?
So I think that's very important, what you say, the early arrival of the festival season. I think this time Diwali itself is coming by 23rd October, right? So I think that it's very crucial, very critical. And I think that everybody is geared to make this a super success because RBI has supported through rate cuts and there's a CRR cut coming into play very shortly. The dates are getting closer, September 5th. So enough liquidity rate cuts. Already 77 basis points RBI governor said has been passed on. I expect the balance 23 odd basis points to pass on. And I think the chances of a fresh RBI rate cut, as I just mentioned, supported by a Fed rate cut and the low inflation, increases the chance. Second is fiscal policy. If you remember, 1 lakh crore. So far, the customers seem to have preferred to save rather than spend. That's the data showing. But maybe they're all waiting for the festive season because that's when discounts come plenty from various manufacturers competing, and NBFCs and banks also will, with reducing the EMIs, make it a very good package for people to go and upgrade their car, upgrade their house, or buy that consumer durable they've been waiting for. So I think this time things are building up for the festive season to be a real dhamaka season, and that news as it filters in the results of the festive season. You see, remember one thing, the festive season promises good top line sales, but how companies adjust their margins we'll get to know only when the results come out in the January 10th onwards, right, for the festive season. But that being said, even that sales will lead to a private capex pickup because capacity utilization will go up in the country. So I think that the market is ready to ignore the international tension at this point and live with the 50 basis points. See, and remember one thing, Kavita, I think I would like to point out that everybody talks about a 50 tariff, right? 50% tariff, but it's actually 225s, right? The first 25 is economic, related to the fact that we have not been able to come to terms on a trade agreement. We have a hard line on agriculture and dairy. They have a hard line on opening up our market. But the second 25 is political. It is not related to India at all. It's to do with Russia. India has a collateral damage in this. We are just a soft target being used by the US to put pressure on Russia. And they are not able to do the same with China because China is too important to the US. They import. The trade deficit with China is $350-400 billion against India it's only 50 billion.
Absolutely.
So Trump is saying India ki isko thapad maro, Russia pe jaake result dikhega.
Right.
So this 15th August ka jo bhi talks hote hain na, if there is a positive signal, then ye 25% hat jayega. So
Absolutely.
looking at two separate 25s, and
Right.
that way, if that really happens, then the market will be really relieved that instead of fighting very uneven battle on 50%, at 25 we are more or less level playing field with the other competing countries.
That's
so I think we'll wait for 15th August to give us that boost, that hopefully those talks should go well for our sake.
Exactly. That's right. Very well explained, Sunil, and I really understand the sentiments while you were explaining all of it. And let's hope something happens and the negotiations are positive when the negotiations happen for the US and India deal talks. But moving ahead, while you say festive, dhamaka is on the cards. Let's hope and believe of the same. While we are talking of the same, what are those pockets and sectors which one should eye from here to December? You see, the consumption, travel, tourism, auto players, leisure, all of which will be in focus when we talk about the festival consumption demand, right?
Yes, absolutely. In fact, you're right now heading for a long weekend with Krishna Jayanti and Independence Day. That's a 4-day weekend when domestic tourism travels on them. Then you have Ganesh Chaturthi around that. Bombay shuts down for a week, right? So you have again a long vacation, and then you have the Diwali weekend. So yes, festive travel and tour and hotel rates are already showing that, right? They've all doubled or something over the last year or so. If you see, the rates are very, very exorbitant. So to that extent, that's good for the hotel and the airline industry. So that's one thing. The second is, I think auto is the key element where I expect a boost because that's where the EMI impact comes in a big way and people build up to buying that next car. And you see a lot of new launches and a lot of competition in the auto sector means that you're going to see really a set of very good purchasing options, if I say, a combination of EMI and manufacturing discounts around Diwali, because that's the time, because around Dhanteras, while the people want to buy gold, it's also a good time to buy new things, right? So I expect the auto sector to really show, and the good monsoon should play out in terms of rural, in entry-level cars and two-wheelers. So my eyes are on those specs because people have always dreamed of buying a good two-wheeler or an entry-level car. It's a very good opportunity to take advantage of this discount. And finally, from a market perspective, and Mansi, I think, remember I spoke about this last time we spoke, that this is a crossover quarter, right? So what happens is that in this quarter, whatever numbers happen, when you go to the next quarter, FIIs and DIIs both look to FY27 earnings to discount it. So automatically you get that the price correction of another 10% growth for the nominal GDP for next year coming through into the valuations. So in that sense, from a crossover perspective, right, we are in that kind of a sweet spot now where you'll build up to a more reasonable valuation probably starting October onwards for the Indian markets. So this is not just about the economy and the growth there, but the markets also should see a big change in their outlook starting October, according to me.
Also, Sunil, I really want to understand the gap between valuations and earnings growth. How are we placed across market caps?
So I think that if you look at the large cap space, we are reasonably placed. If I look at the recent earnings, it's about top line is about high single digit, but bottom line growth is about 10%, which is in line with the nominal GDP. And the valuations, though they are about 21x, I think are still factoring that 220 to 10% growth over the next 2 years. I think large caps are reasonably close to that territory. In mid and small caps, we are dealing at about 31, 32 PE. So what the market is saying is that the current rate of growth, though mid and small mid caps especially are probably growing much faster than large caps, but it's still not good enough. What we need is a much higher growth rate from the mid cap. So the market looks not just as the PE ratio, which is 1 year forward PE, but also at something called the PE growth, the PEG ratio, where you divide the PE by the growth rates. So the higher mid cap and small cap valuations have to be justified by superior growth compared to large cap. That's the expectation. If mid and small caps are going to deliver the same kind of growth as large caps, they are clearly overvalued. But my confidence is there, especially when you talk about auto and consumer durables. All of these are largely mid cap and small cap players, right? So I believe that those earnings will get justified come the next quarter. But right now, like I said, if you look at purely the current forward Ps, mid caps and small caps are definitely valued much more expensive than large caps and much more expensive than their historical averages. So purely from a number perspective, they seem to be overvalued. But if you believe that the growth story will come into play in the festive season and therefore, and the valuations also factor in one more year, I would say that mid and small caps don't look as overvalued as they look from a data perspective. Second aspect is that just because of these valuations doesn't mean that buying support is going to be less, because as I just mentioned, 40% of the new cash in the hands of fund managers is for mid and small cap buying. So which means that despite their seeming overvaluation from a near-term perspective, buying support will continue to be there. So you might see a situation where before those October numbers come in, the valuations go up even higher than today. So to say that they are overvalued, hence avoid, wouldn't be a right decision, because there is liquidity support for mid and small caps from the DII segment.
Absolutely. Quite an insightful conversation. Thank you so much, Sunil, for giving your time and joining with ETNOW. Thank you so much and have a nice day to you. On that note, we slip into a short break, but there's a lot on the other side. You stay tuned.